Welcome to the Daily Update Podcast, where I'll go over the action in the market for Friday, October 17th, and we'll see how things look for Monday, October 20th. It was a choppy but ultimately positive day for the S&P on Friday, where the S&P 500 closed up 0.53% despite a shaky start. Overnight, the futures were down as much as 1.5%, driven by rumors of escalating trade tensions between the U.S. and China. However, the futures clawed back, repairing much of the overnight damage. This resilience is a positive sign, but the lack of strong conviction suggests investors are still treading cautiously. Going over the price action on Friday, prices opened lower but quickly moved above the unchanged level, hitting resistance at the daily pivot at 66.44. After a brief pullback to the opening low, prices pushed above the pivot point again, only to meet resistance at the 66.50 level. By the close, the S&P settled below the 66.75 level, slightly off of the intraday high. Volume was above average, likely influenced by options expiration. Looking at the broader picture, the S&P remains below its 20-period simple moving average, which is acting as overhead resistance and has been for the last few days, but it remains above the 50-period moving averages, which are providing support. This positioning keeps the short-term trend negative, while the intermediate and long-term trends remain positive. The VIX closed at 20.78, still above the critical 20 level, signaling caution. Sentiment, while negative, is improving, moving from 23 to 27 on the sentiment gauge. Moving over to sector performance, different sectors offered some intriguing insights. Regional banks, which really struggled on Thursday, saw a modest bounce on Friday. However, the financial sector continues to underperform the S&P 500, a trend that we've been tracking since last spring. This raises questions about potential vulnerabilities, particularly among smaller banks. Defensive sectors, including healthcare and real estate, did show strength on Friday, with healthcare and real estate posting bullish technical signals. This shift towards defensive sectors could indicate a market that's bracing for uncertainty. Gold continues to make headlines, hitting all-time highs before pulling back below 4,000. Its outperformance against the S&P 500 suggests investors are seeking safe havens amid trade war concerns and geopolitical noise. Speaking of which, the ongoing U.S. government shutdown continues to suppress economic data releases, leaving us reliant on alternative indicators, including Google job search trends. These trends show Americans searching for jobs at recessionary levels despite low layoffs, pointing to a low-hire, low-fire environment that Fed Chair Powell has flagged as a concern. On the macroeconomic front, interest rates ticked back up above 4% with the 10-year yield closing at 4.01%, and the dollar did advance, which could pressure equities if the trend persists. Corporate profits after tax are showing a slight decline, diverging from rising real GDP, which we will continue to monitor. Buyback authorizations, up 16% year-to-date, are a positive signal, reflecting corporate confidence in future growth. Looking at the technicals, we're still seeing mixed signals. The smart money indicator, including the Chaikin oscillator, did turn positive, but others, such as the Chaikin money flow, remain negative. The S&P 500's bullish percent index has now dropped below 50 and is in a downtrend, which is a concerning sign. And the TTM squeeze indicator continues to decline. An unconfirmed Hindenburg omen remains active until November 7th, while a potential ZWAG NYSE breadth thrust, a bullish signal, remains active until October 24th. If both trigger, it could create an unusual tug-of-war between positive and negative forces. Looking ahead to Monday, October 20th, the short-term outlook remains negative, with resistance at the 20-period simple moving average and support at the 50-period moving averages. Key resistance lies at 67.50. Seasonally, October 20th has a neutral to negative bias, with historical data showing the S&P up only 45% of the time in post-options expiration sessions going back to 1980. The earnings season blackout period and ongoing trade war developments, particularly between the U.S. and China, will be critical drivers. Any progress in these discussions, including anticipated meetings between Presidents Trump and Xi, could shift sentiment. In conclusion, Friday's market did show resilience but lacked conviction, reflecting a cautious stance amid trade and geopolitical uncertainties. The short-term trend is still negative, but intermediate and long-term trends remain bullish. It's best to stay vigilant and watch key technical levels, sector shifts, and news concerning U.S. China trade talks. Thank you very much, and I will talk to you in the next podcast.